Happy trading. Greetings, everybody. This is William on behalf of RW Advisory, launching our major macro market triple M video alert in the first week of June 2020. Now, our opening screen is looking at the triple M major macro markets as a year-to-date performance. You can see dashed lines there just showing you the zero mark, but also the minus 10% mark, because of course, post-crash of March, fueled by COVID-19 pandemic scares, has clearly left a big volatility signature across asset class. And so what we are looking at here is the equity, commodity, and G3 FX complex. Right at the top, gold in yellow, actually still top of the pops with 11% year-to-date gains, so still very much a safe haven play and holding its ground, although there is a lot loss of momentum. And then in light blue or shades of blue, we have the G3 FX complex, euro dollar, pound dollar, and dollar yen, and probably most significantly, euro dollar popping a little bit higher while cables actually drifting low within a range. Looking at the equity complex, we have light and dark green, basically showing the S&P 500 and NASDAQ, and of course the difference between the two. NASDAQ more weighted towards those tech-heavy companies is clearly diverging and creating a gap between the two, and that's just managed to push into positive territory at 1.95%, with the European markets represented by DAX in pink still lagging at minus 12.35%. So making new high breakouts, but lagging in year-to-date performance terms. This is a unique screen looking at price swing charts based on gang calculation, and essentially the big benefits are here is filtering the trend noise, offering tactics and timing, particularly in fast-moving markets like the one that we're in. And what we see here is the triple N markets in a grid: S&P 500, DAX, gold, oil, and then euro dollar, pound dollar, all on the screen with key direction, targets, and risk levels. And just looking at the S&P 500, the target there is still 3137 with a risk at 2727. DAX 12,273 with a risk at 10,210. These are swing points, by the way, that I'm reading out to you. So they can be a little bit further away for some of you short-term traders, but still very important key levels in the market. Gold, 1,800, certainly the be-all, end-all level, just above the recent high at 70.66. But the risk of that trend being your friend is if it flips the other way, as it may do in the short-term pattern, the top pattern that we're forming, below 1662, that would be the risk. And then oil side, of course, we've had that V-shaped recovery, minus $40 for the first time ever in negative territory, but it's since pushed up. And right now it's pressuring into the prior swing highs at 36.35, which is in and around a prior gap level. I'll fast tune onto that soon as our one of our final charts. And then looking at the pound dollar, range bound at the moment. Target is still actually bearish at the lows of 119.60, but that would be negated if we break above 127.70. Looking at each of those charts here, we have the S&P 500, the V-shaped recovery, and the big headline is make or break. Now, of course, we've powered up. We've had this kind of very interesting juxtaposed between the month of March, which is the crash month, and then April, where we have the elastic band effect as the market rebounded from very oversold conditions. Now actually pushing not only above the 200 moving average, but also the 66% retracement level of the crash move from March. And that's important, as some of you techies would know, because that is a clear structural level in the market that suggests that, technically speaking, this downtrend or the crash itself may be neutralized if we continue to hold above the current levels or push higher into 31.15.30, which is a further mathematical Fibonacci level at 76.8 and 78.6. One point I want to make and just remind everyone about is the other two axes on the chart here. We're looking at time factors and momentum indicators. These are unique proprietary indicators that I've used for many years. And if we look at the time factor, we can see the crash cycle there from mid-Feb to end March. Mid-Feb is actually when I turned short in the market, but had to get out pretty quickly after we had record volatility back at the GFC 2008 highs. But also we had these liquidation patterns, which I'm just going to quickly highlight on the screen. You could just see here, here, and here. These were late intraday rallies that were later on squashed by margin calls in the market. A lot of smart, big AUM under some of the well-known hedge funds got hit hard. And so, of course, they had to offload some of those positions. And so that smart money tidal wave really became difficult to trade against when looking for the bottom. So why do I mention that now? History can rhyme again if we do get a sharp sell-off, as I expect to happen from a cycle perspective into the summer months. I would say high probability between June and August. So watch this space. I'll be highlighting some key levels between now and then. But on the low side, do keep in mind 2790. If we break below 3,000, 2790 becomes the next big figure. And on the trend side, our tactical and strategic indicators are diverging. So we're seeing tactical being the big long play that we're seeing now, but strategic is still flatlining and starting to build up slowly. Looking at the DAX, of course, there is a lag effect between Europe and the US. US is leading ahead, being the more of a valued market. And we can see here DAX is breaking a new high breakout, but still below its 200 moving average and the 66% level, which I just alluded to. But this time, the print here is at 11,920. So watch 12,102 in terms of the long average, but also that 66% level as well. Looking at gold, certainly everyone's favorite asset at the moment, with the trend definitely being your friend ever since the March low. And that's certainly when we got the short-term bull signal, 30th of March, looking at the 8 and 20 exponential moving averages. But here and now, since mid-April into May and early June, we've had a marked loss of momentum and a triple reversal pattern. Looking at the candlestick signals, what I call a checkmate reversal. If we fail to break above the previous high at 1766, 18th of May, and then further break down lower below the prior swing lows, that will suggest a sharp move lower. And the trigger level for that is 1694.62. That could trigger a $100 drop on gold. So while it is our favorite market trend, trends do bend, especially when they become exhausted, and we would need to look for key moves below 1694.62, into 1640, and into the other Fibonacci levels I've highlighted there on the screen, 1610 and 1570.65. This would be a buy opportunity for some of you long-term investors that are probably already in the money. So this could be a potential buy dip opportunity going forward if we get this move. And then last commodity on the complex, oil pressured under the $35.41 gap. It's a prior gap level, but also silent contagion that is taking place on the futures market. You can see there in the small insert chart, the contract of June, July, August, and September, all exerting downside pressure and suggesting sub $10 as a new normal for the short to medium term at least. There's a media interview that you would have seen circulating on social media, and a report that comes with that, which I can make available, which gives a lot of useful big picture views on oil and what might be expected coming up. And then looking at the currency complex, euro dollar rally exhaustion to 111.50 and 112, question mark there. This has been a pain trade for myself and a few others that have been bearish based upon the long-term and medium-term downtrend, which became range-bound over the last 2 months. Since we had that big swing of about 8 figures on Eurodollar from 115 to 106.40. Again, I've also spoken about that on media, and there's a related report to that for those who are interested. But right here and now, we are, as of yesterday's close, testing the 27th of March swing high, which is critical. And then just above that, the 2/3 retracement at 112. Any sign of exhaustion failure around this level will tie in with a big pain trade the opposite way, back into 107.70, 107.30, but we still have to wait and see. The short-term bull signal remains in play from the 20th of May. So gotta let the market lead the way and not force your own behavioral or strategic bias. If we do break above 112 in a meaningful way, then of course 113 is next, and we could actually be quite close to that major volatility swing high at 115, which we saw during the crash cycle of mid-Feb into end March, similar as we saw on the equity market screen. And then our last chart for this 10 or so minute video, pound dollar trading range between 125.20 and 120. So let's look at this range, not as a time to go to sleep at the steering wheel, but where low vol might lead to a high vol breakout situation. So if we do break above the upper or low boundary, it is something to very much stay alert on and jump on as and when it does happen. The bias is still to the downside into the lows of 114.30. Last point I'll highlight is the probability distribution levels, which I haven't highlighted on previous charts, but those of you who are aware of my analysis will know of them. 130, 123.15 are also key levels based on statistical measures. That's it from RWA Market Video Alert, looking at the M major macro markets. Tune in on a weekly basis. We'll be rotating from M to equities, commodities, and then finally FX rates, taking us through the 1 month cycle every month. And if you're interested in a 2-week trial for intraday updates, please direct message me on rwilliam@rwadvisory.com. Happy trading, everyone, and look forward to seeing you all a week from now. Bye-bye.